It's 2010, a new year and a whole new ball game. There are 5 things realtors absolutely need to know in order to close more real estate transactions this year. Hi, I'm Aaron Knutson with Milestone Mortgage. The information I'm going to share with you over the next few minutes could very possibly make this year the most successful year yet. We in the real estate and mortgage industry find ourselves in a similar situation. I'd like to share with you the 5 biggest challenges we're facing in 2010, and also share with you how we can maximize the opportunity before us. The first challenge we face is the GFE and HUD-1, which took effect on January 1st, 2010. Here are the major differences in the old GFEs versus the new GFEs. Along with these changes are 2 important dates to know about. 1, the expiration date of the interest rate quoted, and 2, the expiration date of the settlement costs listed. If you would like to know more detailed information about how these changes affect clients' transactions, please let me know and I'll be happy to go over them with you. The important thing for you to know is what the GFE is not telling your clients anymore. In order to make sure our clients are getting the information they need to make a sound financial decision, I'll be giving them a total cost analysis so they can see not only the difference that different mortgage options make in their monthly cash flow, but what the true cost of the mortgage will be over a period of time. The interest and fees alone don't tell the whole story. Homebuyers need to know how much each option will cost or save them over the life of the loan. This is an especially important financial planning tool for those who are trying to plan for retirement, a child's college tuition, and more. The other form I'll be providing your clients is an estimated cost worksheet, which will do what the old GFE used to do, and that is itemizing each cost so that they will know exactly what they are paying for. The second challenge 2010 brings is the Federal Reserve's $1.25 trillion mortgage-backed security buying program is scheduled to end in March. This is a chart of mortgage-backed securities, otherwise known as MBS. When mortgage-backed securities go up, rates go down. As you can see, November 25th, 2008 is when the Fed announced their program to buy MBS. Rates had been around 6%. And the Fed's news, rates shot down to 5%, where they have stayed pretty consistently over the past year and a half. The Fed just announced that at the end of March, they will discontinue their MBS buying program. So it is probable to assume that rates will go back up to around a rate of 6%, where they were before the buying program began. So what can we do? The most important thing is to show our clients just how much it's going to cost them while they're sitting on the fence waiting for property values to go down. Now more than ever, our clients need to know how much it will cost them if they wait to buy. Let me show you a specific example. This scenario assumes a first-time homebuyer purchase price of $350,000 with an FHA loan and 3.5% down payment. It also assumes that we're getting 3% from the seller to buy down the rate to 4.25% and another 3% to pay the buyer's closing costs. That will give us a monthly principal and interest payment of $1,691 and a total cost over 30 years of $264,956. You can see at the bottom we have taken the $8,000 tax credit and invested it at a rate of return of 6%. Over 30 years, this $8,000 will turn into $48,181. If the home buyer would like to use that money to pay off the mortgage, they could be mortgage-free in 27.83 years. Let's see what the figures look like in something tangible. Using the same figures, buying a home today with the rate bought down to 4.25%, an FHA loan with 3.5% down, and MIP of 1.75%. The payment will only be $1,691 a month. Another looming deadline Another looming deadline this spring is the end of the homebuyer tax credit, which expires April 30th. To qualify for either the $8,000 first-time homebuyers credit or the $6,500 move-up buyers credit, a purchase contract must be signed by or before April 30th, and transaction must close by June 30th. Also, coming in April, FHA has recently announced that it will be increasing the upfront mortgage insurance premium, UFMIP, from 1.75 of the loan amount to 2.25. They have also announced the possibility of reducing the seller credit of 6% they currently allow to 3% and increasing the required minimum down payment from 3.5 up to 5%. Now let's take a look at the figures if they wait until May to buy their home. We are going to assume that the rates have gone back up to the point where they were at when the Fed's buying program took effect, 6%. We will also assume that FHA has reduced the amount of seller's contribution from 6% to 3%, and this buyer had no money for their closing costs, so needed the 3% from the seller to pay for those instead of being able to buy down the rate. Look at the amazing difference, $380 per month and an additional $135,090 over 30 years. This is an excellent example of how much a difference it can make in how your clients' offers are structured. Whether or not seller credits used for closing costs or buying the rate down can make a substantial difference for your clients and their financial well-being. Now let's take a look and see what would happen if the same client bought now instead of later, but could actually afford the higher monthly payment and took the $380 that his mortgage would have cost him if he waited to buy and instead applied it to an extra principal payment each month. He still has his $8,000 tax credit working for him, but with the additional $380 per month, he's able to be completely mortgage-free in 18.75 years and have a net worth of almost $780,000. I've not included any future appreciation of his home, simply so you can see the effect of his strategy itself. It really does make a difference on how your client's loan is structured and if funds are applied to his closing costs, buying down his rate, or put towards extra payments. The one thing that we could certainly count on in 2010 is that interest rates will be volatile. Here's a snapshot of a typical day. Every yellow diamond signals an alert and possible rate change. There are 3 on this day between 7:30 and noon. It's important that your clients have someone who is watching the market and can give them an up-to-minute advice on when to lock in their rate. You can see why rate shopping is almost worthless these days. Unless you can get your quotes all within about a half hour of each other, rate quotes really don't mean much. Not only does this service allow me to keep a minute-to-minute eye on the market, it also gives me a daily commentary on where things are headed in the future, and also lets me track the different lenders and know when they are changing their rates and by how much. So yes, 2010 holds challenges for us, but we can turn those challenges into opportunities. We have the answers and we have the tools. Our clients need us. Let me help you structure your offer so that your clients can meet and exceed their financial goals, and you, in turn, will have more referrals than you could possibly handle. With Aaron Knutson at Milestone Mortgage, you can guarantee whether you're going jumbo, FHA, or conventional, I will close your transactions in less than 30 days. So let's make it a great and successful year.